I'm going to give you an idea of active management from your perspective, from an investment, from a client investor standpoint, and what this means to you. We're going to talk about with active management. We're first going to talk about what we see as what we do see as the challenges of next year and currently, and has been around actually for 6 months to at least a year, is inflation. And the reason that inflation has not been a word that has really been mentioned probably since the 90s. And the last time that we really had it was back in the 1980s. So most people have no track record of this, no real understanding of it. And when we talk about inflation, I use the word insidious is what came to mind. I really want you to understand the negative impacts that inflation can have, because you've got money sitting in your checking account. Well, that money is buying less and less each month. And I'll give you an example of that. Typically it takes about $28 to fill up my car last year. And now I'm spending over $42 to fill up the car. That's a 40+% increase in the price to fill that car up. And then if you take that, and inflation flows through to so many things: food, the transportation costs, getting to work, going to pick up the kids, whatever, all of it flows through to higher prices. Therefore, the people that are most at risk of this are typically retirees who are on a fixed income. You have a pension coming in. Social Security is a pension, and it's actually one of the few that has a cost of living adjustment. This past year was the highest adjustment they've ever had because CPI was so high. But it's still not catching up actually with the real world inflation that's out there. It's nice to have the benefit, but it's not getting you back to equal. Okay. And so when you see the erosion of what your dollars are buying, it's one thing if you want to buy less gas. What are you going to do? Buy less food? Some people get to make the decision of, okay, I'm not going to buy a ribeye, I'm going to buy a sirloin, or I'm going to buy ground beef. But, if you've got people that are already at the ground beef pace, this is where you start to see a real impact upon people that are living day to day on a fixed income, and they're watching all of the costs go up. Inflation also adds risk and volatility to all financial markets. And it's not that there are occasions with rising rates are also going to lead to higher stock prices, but they tend to lead to bubbles. And if you start looking at buying real estate, well, if interest rates are going up, then mortgage rates are going up. My current mortgage I just got a couple of months ago is 3.12%. If I wanted to refinance that house a year from now, and let's say rates are 4.12%, I'm paying a lot more in interest on that mortgage. Or if you have a new home buyer that's going out a year from now and interest rates are increasing, they're not going to be able to buy the same price of home. What's going to give is they've got a certain price that they can pay on a monthly basis for a mortgage. That means that the price of the house that they're buying is going to be less. It also flows through to cars, and you see people financing vehicles, and they're not going to be able to afford the higher end vehicles. They're also not going to be able to afford washers and dryers and all those kinds of things. There's a great video, and we've put the link on here, and the link is actually in the notes to a video from the Wall Street Journal. And the name of the video is Tapering, what it is and why it makes markets shudder. It's the shocks, not just to the stock market. And one thing I want to remind people of, the stock market is only about 1/9 the size of the bond market out there. The bond market, where corporations, governments, local entities are out borrowing money by issuing bonds, there's 9 times the amount of money within the fixed income bond market than there actually is in the equity markets. Okay. And when you start seeing price increases, and let's think about it from the federal government, they've got $28 trillion worth of US government debt out there. If interest rates go up by 1%, and I need to go do the math on this, kind of afraid to be honest with you, we start getting into a rising interest rate, And that, not just the debt at the federal government level, but at the state level, at ISD levels, at pension levels, could really negatively impact not just, well, all financial markets. And talk about why active management and what does that really mean? Basically, the two general categories are active management versus passive management. Active management is what Shadowridge does. Passive investing is when you go out and you buy indexes. You buy something and you buy and hold. We like to call it buy and hope. And the reason I call that, if you go back to last year in March and April of last year, the S&P 500 was peak to trough down 35%. If you go back to 2003, it was down more than 40%. And if you go back to the Great Recession in 2008, the S&P 500 dropped more than 50% from its high to its low. 2003 was a little bit shallower, but the interesting part was it took a lot longer. It took almost 3 years to get back to where the markets had been before. So if you're engaged in this, you're hoping that the markets are going to turn, you're going to get back there. And this is the biggest thing that we want to do. We want to have real returns via what we call positive compounding. As my son likes to say, you don't have to be right, you just don't want to be wrong. And what we're doing there is we don't want to take a 35, 40, 50% downturn and hope that the market returns. Modern portfolio theory also talks about assuming rational investors. And I'm sorry, we all like to think that we are rational, but when we are under times of duress, we can make irrational decisions and act irrationally. And those are the problems that we see with the passive investing. It doesn't lead to real returns. It leads to something less than that because you're always trying to beat this fictional index that's out there that has nothing to do with your financial goals. We take a disciplined investing approach. Things that I love what Ryan is going through and talking about, things like that are real indicators. And these are not projections and forecasts. And you heard him say it, we follow the data. And that data is pretty much real time, daily. And it is things like the advanced decline ratios, where money flows are going, sector strengths that he was covering. It was interesting to me that right now, the sectors that are normally a hedge against inflation are underperforming. Well, this is a changing and evolving market. We are disciplined in things, but we are also flexible in the fact that we're going to move from asset categories. We're going to see what the reality of the situation is and move to that and try and work on not having a significant down year, trying to get back to even. So what does that take a look at? And I do want to point something out because, as many of you know, I have a sailing background. And so here's a sailboat that's on extremely calm water, and all of a sudden here comes the squall line. I can promise you that as we go forward into 2022, and this is the guarantee I wanted to say at the beginning of my presentation, but there's one guarantee I will make to you, and this is a guarantee about life. There will be the certainty of uncertainty, okay? Having the financial agility to respond to the reality of the situation. We're looking to make sure that we are not participating in the storms that are out there. We are altering course and looking for the asset categories that, when times are bad, we are looking for safety of principle. We're, as Ben Franklin put it, we're looking for return of our dollar, not return on our dollar. But then the interesting part is when things are on sale and we see things turn positive, like we did last year, we participated a lot in the up markets. Ryan was talking about this past November, that we caught that nice uptrend. And actually the performance for those portfolios was positive when the S&P 500 was negative. And actually, we do better in these stormy times. This is where we really add value, okay? And liquidity is the key to it. And it's like, well, what are we talking about liquidity? If you remember back to 2008, everybody was buying, selling homes, and real estate prices were just going nuts, and everybody could get a mortgage. And I mean, literally, all you had to do was fog a mirror and prove that you had a pulse, and you could get a mortgage. And so everybody's out there buying and selling, trading. This was really bad in Florida, Nevada, and Arizona. And all of a sudden, literally overnight, a switch flipped. There was no more lending. Everybody had the loans that they were there, and nobody was buying real estate. They certainly weren't buying the real estate at the inflated prices. I talk constantly about the movie The Big Short. This is a great example of it. It gives you real world. I just think it's phenomenal, and take a look at that.